We'll get started. Good evening, everybody, and welcome to tonight's webinar, Preparing for Tax Season. I'm Mike Hebron, the Chief Operating Officer and one of the partners here at Level Financial. And tonight we'll be joined by Lisa Mrkall, MBA, a licensed CPA with Tronconi, Segarra and Associates. Before I formally introduce Lisa and hand the presentation over to her, just a few ground rules for tonight's presentation. First, to keep things interactive, please use the chat function at the bottom of the screen. If you enter questions in there, if you have a specific question that you'd like answered during the presentation, you put that on there. I'll interrupt Lisa at the appropriate time, or Lisa, if she sees the questions, can answer them herself, and we'll try to answer them live for you. If you have something more personal or something that might take a little more interaction, we do offer our text line for people that are in the presentation. You can text the word tax to 716-727-5047, and we'll make sure that we follow up with you on your specific question. So in other words, if you just text that word tax to that number, we'll make sure we follow up with you tomorrow and ask you what the specific question is, and hopefully put you either in touch with your financial advisor who can answer that, or put you directly in touch with Lisa and perhaps she can answer it. A recording of the event will be sent out to everybody so that you have it at the end of this. So let's get started. By means of introduction, Lisa is a CPA licensed in New York. She has a Bachelor of Arts degree in Health and Human Services from the University of Buffalo and a Master's in Business Administration and Professional Accounting from Canisius College. Her areas of expertise include individual taxation and planning, corporate taxation and planning, small business consulting, the Affordable Care Act consulting, and compliance and general ledger services. Lisa also serves on various committees at the firm, including the Recruiting Committee, the Firm Technology Committee, Business Development, and Performance Evaluation Committee. So without further ado, let me just hand it over to Lisa, and we'll start the presentation. Lisa, thank you.
Wonderful. Thank you so much, Mike. Good evening, everyone. Again, thank you, Mike, and for the introduction, and to the team at Level Financial Advisors for having me this evening. I was chuckling a little bit when I thought a little bit more about the tax helpline. I kind of wish in a way that we had that here, that we could just text the word tax and get some help when we have complicated situations. That would be really cool to have. But no, we certainly have a lot to talk about this evening when it comes to getting ready for tax season and preparing everything you need to get through some of those forms and documents, and some new items to be aware of this year. So let's jump right into our first slide here. We have our agenda. This is our agenda for this evening. I hope we'll be able to, really cover most, if not all, of these items here tonight. I base my topics for my presentations on common questions and issues raised by our clients, our colleagues actually as well, even our friends and family members who come to us with questions on different aspects of their tax and financial situations. So these are, areas that such as different deductions and tax credits that our clients and so forth may otherwise not be aware of. So we'll cover some issues related to what's new for individuals in 2023. And for example, while many of the tax benefits related to the pandemic, to COVID-19, have expired or reverted to their pre-pandemic levels, expanded health insurance subsidies, for example, are extended through 2025. These are those premium tax credits. So more and more taxpayers at slightly higher income levels can benefit from that. We're going to talk about the Secure Act 2.0 that was passed in December of 22. That has some expanded key retirement provisions, including automatic enrollment in retirement plans, among other things. Different ages now for those required minimum distributions. So we'll go through that as well. At the time of this presentation that we're aware of, there's no active pending legislation in Congress, but Congress is expected to pass an omnibus spending bill, which could address various temporary tax provisions. There are a lot of things to be aware of in terms of the sunsetting of the tax law changes that went into effect in the beginning of 2018. Sunsetting really is just, the thought of these tax laws kind of either going away, sunsetting, expiring, or some of the tax law provisions that were not in effect coming back into play. So we will see how that goes. We have about 26 months or so until that sunsetting takes place. So we'll go through a couple areas related to that tonight as well, just so you can start thinking about some potential planning ideas as you think about the next couple of years until those tax law changes, could potentially take place. We've got some other items we're going to cover here. So I'm going to really go ahead and just get right into our next slide, which is on our upcoming, let's see here, there we go, our upcoming tax deadlines and form deadlines. For many of you, you might not ever need to worry about any of these tax deadlines, but a lot of people do. The next one coming up is going to be in January 15th of 2024. It's the fourth quarter estimated tax deadline for those estimated tax payments. Sending in your 1040 ES form with your check, or going online and paying your federal income tax estimated payment. So in terms of deadlines, just to kind of take a step back, about a year and a half ago or so when I gave this presentation, we had just come out of a very chaotic time of changing tax laws, those infamous stimulus payments, ever-changing tax return deadlines. So in 2022 and this year in 2023, and hopefully going forward, we're back to the usual tax deadlines, as you can see here, for individuals and businesses. Here you'll see the upcoming due dates for estimates and forms affecting individual taxpayers, and when 1099s, for example, are due to recipients. So lots of dates here. A lot of them are, April 15th. Tax forms are due on April 15th of this coming year, 2024, and include the 1040, the 1041, which is the income tax return for estates and trusts. The C corporation tax return is due on April 15th. That's not listed here. As typical with any year, if you need more time to file your return, to prepare things, get organized, and need to apply for an extension, you can certainly do that. That's a 6-month extension of time to file. You'll just want to be aware that if you're extending, it's an extension of time to file those forms, does not grant you an extension of time to pay taxes that you might owe. So you do have to estimate those as best you can at that time. Otherwise, you could be subject to penalties and interest. And you have to file your extension request no later than that regular due date of the return, so that April 15th due date. At the bottom, the asterisks have to deal with opening day. Those of us who are tax preparers anxiously await, the date the IRS announces for when they begin to accept tax returns and processing tax returns. So that magic date is January 18th of 2024. I don't have a countdown clock, but I probably should, just like I kind of do for the April 15th deadline in a way. But if you don't need to wait for forms that typically are issued later than this date, like 1099s or K1s, you might be able to file early and take advantage of, the IRS not being super busy at that early time in the filing season. If you have, kids that need to file, this is usually when we try to grab those and get those done. Because for the most part, for example, they might just have a W-2 or, a couple W-2s, and those are great returns just to get out of the way and get those refunds started. So, all right. So now we're moving on to, some more nuts and bolts, some information on filing status and dependents with some of the points here on this slide. So first we'll start with your filing status. So what is meant by filing status? So filing status determines the rate at which income is taxed. There are 5 filing statuses, and those are single, married filing jointly, married filing separately, head of household, and qualifying widow or widower with a dependent child. The status is determined, the marital status is determined for the entire year and is determined as of December 31st. A taxpayer who's married or divorced at the end of the year is treated as if they are married or single all year long. So taxpayers who are separated or divorcing should definitely consider tax implications of property settlements, alimony, child support, retirement plan allocations, and other related items, and plan accordingly. More than once, we have been involved in planning for individuals and tax-related scenarios during a pending divorce. Not always the most pleasant of situations from our standpoint, but does help to be, does prove to be helpful for the couple in a very difficult time, just despite what's going on, they are not as interested in, as a couple, as a unit, in paying any more tax than they have to. So we can sometimes help with that. Proper timing when the change in marital status occurs can really, save on taxes. This translates to potentially ending the marriage prior to year end to result in tax savings. Just depends. It's not a one size fits all, but in contrast, if the married status results in a lower tax liability, delaying the divorce, on the other hand, or legal separation until the beginning of the next year might be advantageous or advisable. Many of you have probably heard of the marriage penalty. So that's a potential pitfall that exists whenever the tax on a couple's joint return is more than the combined taxes each spouse would pay if they weren't married and each filed a single return. So in other words, the sum of the parts does not equal the whole. Usually this penalty kicks in, honestly, at higher tax brackets, but can also kick in through tax treatment of other items, including student loan interest deduction, net investment income tax, certain deductible IRA contributions, the child tax credit, itemized deductions, just to name a few. So lots of things to look at there in terms of the tax implications. But so just a quick note about the head of household filing status. A taxpayer who currently qualifies for the head of household status may benefit from pulling more income into this year if circumstances are going to change. So that would mean, for example, if the individual is going to be getting married and then would leave that beneficial head of household filing status, those have lower tax brackets, lower tax rates. So that head of household status would end, and maybe you want to postpone those events. If you have a qualifying child who will not be your dependent, or a qualifying child in the next year, pull more income into the year when you can still take advantage of the head of household filing status. And again, that higher standard deduction or lower tax rates. All right. And also just a quick note on the qualifying widower status. Accelerating income, again, pulling that income into your tax year sooner than maybe next year. That also might benefit widows or widowers whose spouse has died in 2022 and who are entitled to use joint return rates in 23 and 24. All right. So a common question we get asked, and I'm seeing that come through now actually, is what is meant by the head of household specifically? Do I need to have a child living with me to use this status? Okay, definitely great question. So there are a lot of filing statuses to sort through. This is basically one of the more favorable filing statuses that can be used if you're single or unmarried and maintain a home for a qualifying person, such as a child or relative. This filing status provides a larger standard deduction and more favorable tax rates, including the federal income tax. No change on the state side, but in terms of the tax rate, but definitely on the federal side. So there used to be a deduction for dependents where you would quote unquote write off your dependent, your spouse and children, and there was a certain amount for each of those. Well, with the Tax Cuts and Jobs Act, that is now zero, and that is going to be the case. Well, it has been the case since 2018 and will still be the case until the end of 2025. So the Tax Cuts and Jobs Act did reduce that exemption on the federal side, which is something, again, we may see come back into play if that particular tax provision does expire. All right, so a qualifying dependent or a dependent or qualifying relative, just as a refresher, the individual must be under 19 at the end of the tax year, a full-time student who is under 24, or permanently disabled. To be a qualifying relative, the person must have in 2023 less than $4,700 of income and meet a couple of other requirements related to citizenship and so forth. Usually requirements that aren't hard to meet, but definitely that income threshold is there. So it might be a good idea to review residence, support, or income tests, and that they are likely to be met before year end. Okay, now we've got a slide here on income, AGI, or adjusted gross income, and taxable income. So much of what we accountants do and financial planners do before year end in terms of tax planning commonly involves methods for increasing and decreasing adjusted gross income if the situation warrants this. So generally speaking, most times taxpayers are going to aim to decrease AGI to reduce their overall tax liability, just continue to push out or defer tax payments that are coming due on certain types of income. So there are some instances actually when it will make sense for the taxpayer to increase AGI and pull income into a particular year. And so we're going to talk about this kind of in the general realm, but we're also going to talk about it in terms of what it might look like 2 years from now or so when we're looking at potential tax rates increase, the tax brackets changing to the older levels, to those higher standard deductions going away, and maybe thinking about pulling some income into, say, 2025 to avoid, being subject to those higher pre-Tax Cuts and Jobs Act rates when that sunsets. So kind of a mouthful, but I'll break it down. So who should increase their AGI? So again, not a one size fits all. Something to consider though, if a taxpayer who expects to be taxed at a higher tax rate next year should explore some strategies to increase AGI now this year by accelerating the recognition of income. So this might be applicable to a taxpayer in a higher tax bracket next year if the taxpayer is graduating from school or a training program and moving on to the paid workforce and jumping up in a tax bracket. Maybe figure out ways to bring more income into the year now. Again, like I said before, the head of household or surviving spouse status might be ending after this year. The taxpayer plans to get married next year and will be subject to a marriage penalty. Taxpayer expects to be eligible for one or more credits next year, such as the child tax credit that is subject to phase out when the AGI reaches certain limits and otherwise not eligible for the credit next year, or this year, I'm sorry. Okay, so then who should decrease AGI? So we're going to, again, review a couple things here. A taxpayer who expects to be subject to the same or lower tax rate next year should consider deferring income recognition. They might be in a lower tax bracket for a couple reasons. On the flip side, the head of household status might come into play next year. So let's think about ways we can defer or push income that we would be realizing into next year when you have a lower tax bracket and a higher standard deduction. Maybe there's going to be a lower tax bracket due to retirement, job change, or other circumstance. Or if the taxpayer is currently a child who will escape the kiddie tax next year and be in a lower tax bracket than their parents. So in terms of certain thresholds, the adjusted gross income threshold, some tax benefits actually phase out at certain AGI threshold. As year end is coming near, taxpayers who would otherwise qualify for a tax benefit should consider strategies to reduce income this year to keep their income level below those thresholds. Some of these areas subject to these thresholds are non-deductible Roth IRA contributions, deductible traditional IRA contributions, child tax credits, qualified adoption expenses, and even student loan interest deductions. Okay, so there's definitely a lot of techniques here that can be used for accelerating or deferring income. A lot of them are honestly out of the scope of this particular presentation tonight, but things like redeeming savings bonds and recognizing that interest is one way to accelerate income that I haven't mentioned before. Harvesting capital gains. On the flip side, for decreasing AGI and maybe kind of staying within some of those thresholds, is harvesting capital losses and making deductible contributions to IRAs and HSAs. So those are ways you can look at decreasing income. All right, so let's move on to capital gains and losses, since we just mentioned that. One of the appropriate year-end planning strategies here is, for capital gains and losses really depends on many factors, including an individual's taxable income, tax rate, amount of adjusted net capital gain, and whether the individual has unrealized capital losses that they can start to realize. For high income taxpayers, these planning techniques also have to take into account the net 3.8 net investment income tax and the additional 0.9% Medicare tax for certain individuals. So when to recognize gains and losses. So as year-end approaches, the taxpayer's income, gains, and losses for the year become more certain. reach out to your broker, your advisor, get some interim statements and see how things are looking. This provides, some strategic planning opportunities. A lot of these strategies also apply to reducing the impact of the net investment income tax. So recognizing long-term gains. So this might be beneficial if the taxpayer is going to be subject to a higher tax rate in the future. For taxpayers with taxable income below, the zero rate threshold amount for capital gain tax, consider recognizing those long-term gains now up to the threshold amount. The long-term capital gains rates range from 0% up to 20%, and there are different thresholds based on filing statuses. For example, the married filing joint 0% capital gains tax rate is up to $89,250 of income, of taxable income. The 15% bracket really is pretty wide. It's about $89,000 to $553,000 at that 15% capital gains tax rate. So then moving on to capital losses. So avoid recognizing long-term capital losses if taxable income from long-term capital gains and other sources will be below the zero rate threshold amount, or if the taxpayer will be subject to a higher rate next year. However, taxpayers who have no capital gains should consider recognizing some capital losses up to $3,000, which is actually $1,500 in the case of married filing separate. So that can be used to offset ordinary income, which is going to be that at the higher rates compared to those capital gain tax rates. I want to mention wash sales. We get a lot of questions on this. For those who don't know, wash sale is a rule that prevents a taxpayer from recognizing a loss on disposition of stock or securities when substantially identical stock or securities are bought and sold within a 61-day period, 30 days before or 30 days after the date of the sale. So a taxpayer in this situation can't sell the stock to establish a tax loss and simply buy it back the next day. So I'm just going to cover passive activity limitations briefly now. A lot to unpack there with different things like material participation and non-passive activity. So a passive activity basically is a trade or business activity in which you don't materially participate. One test there is, do you spend 500 hours or more in that activity during a particular year? That might mean that you are materially participating and it is not a passive activity. Passive activity, so if the expenses of the passive activity exceed the income, a passive loss results. Passive losses can only be used to offset passive activity income. So you have to have apples to apples there.
So Lisa, we have a quick question here that came in. This question says, does a 16-year-old with $3,000 of income, W-2, get taxed at its own rate or its parents' rate? Can she use IRS Free File?
Oh, yes, definitely. So a 16-year-old, so actually I have a 17-year-old who's going to have about that much income. And of course, my answer is it depends. So I've set up my daughter's federal withholding to be zero because I know she's not going to make enough money that would surpass her standard deduction. So as long as she doesn't make over the standard deduction amount here. So right here I have a slide up actually. So if the child is not going to make more than this amount in their earned income from their wages, which isn't really typically the case at that age, or even a few years after, then do they have to file? No. But if they filled out their tax forms when they started their job to say, okay, withhold just a very small amount of taxes, then yes, they are going to want to file to get that federal withholding back because they're going to have all of it deducted using the standard deduction up to $13,850. The state is a little different because the standard deduction is not high enough, and it's kind of not the same situation there. So typically, yes, you're going to file the federal return to get that withholding back. Most people don't know that you don't really have that you have the option to not have any federal withholding taken out. State, I always have people just take a, bare minimum out so that they don't, when kids owe $75, $100, I think it's the end of the world. So, but yeah, there are definitely free filing opportunities on the IRS website, really informative. I'll actually make a note and I can send you the link to those. There are real easy software products to use. I use them myself for a couple of friends, and they're very easy to use. Got to have your driver's license handy, a canceled check or your banking information and in your W-2, and really that's pretty much it. The driver's license is needed because you're going to have to put in information from the front and back of the driver's license when filing the New York return for anyone, child or otherwise. It's an identity theft prevention measure that New York State employs. So kind of a pain, but it does help along those lines. So usually when you launch those federal free file websites, it'll give you tons of options of which software to use. Many of them are brand name products, never have had an issue there, and they'll launch you right into the free state filing option as well. Did I answer the question? I think I answered the question, right? Gave you more than you needed. So, okay. All right. So we will talk about some standard deduction items and above the line deductions here real quick. So we've got really, this is what clients want to hear about, which is case in point right there. So how can I pay less taxes or no taxes or whatever the case might be? What's our clients say, what's out there for me? What's out there for me to take advantage of? So some good news is that the standard deduction across the board of all these filing statuses increase with inflation adjustments. Here are the 2023 standard deductions for the filing statuses I mentioned before. In addition, taxpayers who are 65 or older and those who are considered blind by the IRS definition actually have a little bit more of a standard deduction to add on of $1,850 for those in the single and head of household statuses. And $1,500 for married, joint, or married filing separately. So those amounts get added to the base standard deduction. Our clients who are, well, here we go. I'm going to get right back into that same topic. So our client dependents who may be filing a return and still being claimed as a dependent by someone else have standard deduction of either a flat $1,250 or however much the earned income was, plus $400, but never more than never more than their available standard deduction, which for children was going to be, this $13,850. But again, they would file if they've had federal withholding so they can get all that refunded back to them. So as many of you I'm sure are aware, if the standard deduction is less than your collection of itemized deductions, there's going to be some time that's going to be needed to be spent to gather those itemized deduction receipts and support and maybe 1098s to prove out your mortgage interest deductions, medical expenses, all different types of things. It can be cumbersome to gather up all those deductions. I have a lot of clients ask, during tax time, do you need all my receipts? And of course, my answer is yes. I want to make sure that I cover all the bases. Just because you didn't itemize in one year doesn't mean you can't itemize the next year. Give me everything. I want to analyze all the documents and all the receipts to make sure we are taking, the most optimal set of deductions for you. Might be standard, might be the itemized. Of course, with the tax law changes since the beginning of 2018, we have so many more people, taking that standard deduction. Mortgage interest is an interesting one. I just want to mention that quickly. I'm going to flip to my slide here. Okay, so mortgage interest is one I want to particularly mention because I am seeing I'm seeing where we've got some limitations here that we have to follow the rules and impose that on clients taking mortgage interest deductions in some cases, depending on when the loans were taken out. So December 15th of 2017 is actually that magic date for most debt, qualifying debt taken out after December 15th of 2017. Only the interest of up to $750,000 of debt can be taken. So once it exceeds that number, we have to start prorating and reducing the amount of mortgage interest that can be deducted on the itemized deduction schedule. It's happened a couple times in the past year. So just be aware of that if you do have higher mortgage loans that were taken out after December 15th of 2017. Okay, so just a quick note on charitable donations. No more than 60% of the taxpayer's AGI can be deducted. So there's that limitation there to be aware of. In some cases, 20, 30, or only 50% limits might apply, sometimes related to capital gain property. Sometimes a qualified appraisal is needed if you're donating property worth $5,000 or more. So just be aware of that for larger donations of that level, with the exception of securities that are being donated. All right, casualty and theft losses, I don't have listed here on the slide, but this used to be a much more wide-reaching deduction, but is now only available when attributed to a federally declared disaster, subject to some limitations as well, but are now more favorable. However, the deductions are, like I said, it's only allowed if there was a federally declared disaster. We've had to visit the FEMA websites, get lots of information from FEMA to make sure that the disaster, for example, Hurricane Ian in Florida, and 2 clients actually that were allowed to use this deduction for damage to their property as a result of Hurricane Ian. I think that was last year. And so they were able to, take some deductions for the value of property that was lost and compared to the value before the hurricane. All right, so I think I was starting to mention earlier, we had some potential sunsetting of tax law changes that happened after the Tax Cuts and Jobs Act was passed in 2017. So some of these provisions are going to come to a close, as I keep mentioning, but unless Congress acts to extend some of them or reprieve them. So it brought, this act had brought sweeping changes, honestly, to the tax code for both businesses and individuals. Some permanent, some non-permanent. They're set to expire at the end of December in 2025 and revert back to the pre-TCJA levels, TCJA meaning Tax Cuts and Jobs Act. So Congress could still act and, and reach an agreement that would extend at least some of these provisions. There's a slight bit of political attention, and I put air quotes around slight bit of political tension, and general unsteadiness of the global economies, so this may be an opportune time to explore some strategies. So that being said, starting in 2026, the standard deduction amounts will revert back to about half of where they are now. Hence, that could increase the need once again to keep up with various expenses that would collectively be these itemized deductions. A big hot topic in this area is known as SALT, or state and local taxes. So this used to be an unlimited deduction on the Schedule A, the itemized deduction schedule, and collects a couple different types of taxes that we pay: property taxes, state income taxes. The TCJA put a limit of $10,000 on this that was not indexed for inflation. So it's been $10,000 ever since the tax law changed. It's called the SALT cap. This left many taxpayers, especially in states like New York, with a high state and local tax, limited to the standard deduction, since this was a significant itemization previously. After 2025, this limitation is set to be removed, and taxpayers will again be able to fully deduct SALT taxes on their tax returns if they itemize their deductions. So this is a very hotly debated tax topic. A lot of other programs have come into play. For example, the New York State pass-through entity tax that some of you might be aware of. So again, who knows what's going to happen? There's a lot of chatter about it out there. So this limit might be increased or removed even prior to the sunset deadline in 2025. So more to come on that. The medical expense AGI floor. So with the onset of the TCJA, it lowered the threshold that was applied to medical expenses from 10% down to 7.5%. So this change helped a lot of taxpayers, especially those in retirement, claim even more deductions over the past couple of years due to medical expenses. Don't see a ton of clients taking the medical expense deduction, but we have them provide their receipts and documentation anyways. If clients are privately paying for long-term care, we do get a lot of great documentation from our facilities here locally that provide what that nursing care, that skilled care involves, and can lead to significant deductions. All righty. Miscellaneous itemized deduction. So a really common itemized deduction that used to be taken prior to the tax law changes was the miscellaneous itemized deduction. Our fees, accountants' fees, tax preparer fees, and some advisory fees, investment advisory fees were all partially deductible. The TCJA completely removed this itemized deduction, not New York, but just the IRS, but it will be reinstated after 2025, assuming everything goes back to the way it was. They're subject to a 2% of AGI floor. So some other expenses that might fall into this category are unreimbursed employment expenses, management fees, trustee fees, tax preparation fees, hobby expenses up to hobby income, and fees related to fighting the IRS, which hopefully does not apply to anyone. The itemized deduction limitation, so fondly known as the PEAS limitation, named after a legislator or congressman, I believe. The TCJA suspended this limitation that was in effect prior to its passing. It prevented high income taxpayers from whittling away at their taxable income by claiming very, very large and numerous itemized deductions. So again, that was called the PEAS limitation that might come back into play. Another item that might come back to play, which actually isn't an itemized deduction, but is the personal exemption. This was available to taxpayers below a certain AGI threshold. It was where taxpayers were allowed to deduct a personal exemption for themselves, their spouses, and each of their dependents from adjusted gross income. New York State, for example, still does have this exemption amount for spouses and dependents. Federal does not at this time. So it might sound like a big additional deduction, but at the same time, the standard deductions probably will be severely cut back to those pre-TCJA levels. Really just depends on every taxpayer's individual situation and what happens over the next couple of years with tax legislation. Okay, so moving on to education and education tax benefits. So taxpayers who are paying or saving for their own or their dependents' education have several opportunities to maximize education-related tax benefits before year end. We have the AOTC, or the American Opportunity Tax Credit, and the Lifetime Learning Credit that can be claimed to offset the cost of education. The AOTC is, and the Lifetime Learning Credits, or LLC, phase out for higher income taxpayers. The AOTC is a credit for qualified education expenses paid for an eligible student for the first 4 years of higher education. So those first 4 years, bachelor's degree. The maximum amount of the AOTC is $2,000 per year per student and is refundable up to $1,000. The rest, or the $1,500, can become a non-refundable tax credit. Refundable only if, or claimed only if the tax exceeds that amount. The Lifetime Learning Credit is up to $2,000 per return for qualified tuition and related expenses paid for eligible students enrolled in an eligible educational institution. This includes undergraduate, graduate, and professional degree courses, or in courses to acquire or improve job skills. There's no limit on the number of years a taxpayer can claim the Lifetime Learning Credit. The taxpayers, in the way of some planning strategies here, the taxpayers can claim credits for eligible expenses paid for education that begins this year or during the first 3 months of next year. So paying ahead, a taxpayer who hasn't already maximized the education benefits for the student this year can consider making the spring tuition payment before this year ends. But nothing past that. Student loan interest deduction. While it's really not been widely taken lately, and we'll talk about that in just a moment, interest paid on student loans, qualified student loans, is deductible up to $2,500 per return, not per individual who's paying on the debt, except for married taxpayers filing separate returns. That is denied. That deduction is denied for married filing separate taxpayers. The deduction phases out at higher income levels, and might fall within the phase-out range for the student loan interest. Taxpayers who might fall within the phase-out range this year should try to shift income to next year so that they can, so that their current year income can fall below that phase-out threshold. And if needed, I can provide some follow-up information on what all of these thresholds are. So again, student loan interest deductions might be lower this year because, due to the COVID-19 relief that reduced interest on certain student loans to 0% and suspended student loan payments. Taxpayers should definitely consider whether making additional student loan payments before the end of this year will enable them to fully utilize that deduction for student loan interest. Interest is probably going to be lower again for 2023 since the student loan repayment requirements just recently kicked back in, which is much to the dismay of many millions of borrowers, that's for sure. 529 plans, a lot of people are familiar with these. These are the qualified tuition plans, and it's a tax-advantaged savings plan designed to encourage saving for education costs, gross tax-free. They are sponsored by states, state agencies, or educational institutions, and contributions to these plans are considered completed gifts for federal gift tax purposes. 529 plans enable participants to pay prepaid tuition costs for a particular beneficiary or contribute to an educational savings account established to pay a beneficiary's elementary and even secondary school education, school tuition, and higher education expenses. Certain apprentice programs, and even up to $10,000 of qualified student loan debt. A lot of people aren't aware of that. On the New York State tax return, we do get a deduction limited to $5,000 or $10,000 for married filing joint couples. It's a deduction from income for contributions to the 529 plans. Okay. We are going to move on to retirement. So this.
We have a quick question on here real quick. Somebody put one in. What is an example of shifting income from this year to next year, especially for a self-employed person?
Let's see. So shifting income. So let's see here. So for a self-employed person, so shifting income or even deferring expenses would probably have the same result. So you're reducing income in 2023 and pushing it to 2024. So again, it's not going to be one size fits all. It's going to depend on each individual situation. So for example, if you're going to want to shift income into 2024, an example that we see very often, more so than shifting actual receipts or revenue, would be, considering purchasing large pieces of equipment or deferring that activity until January 1st or 2nd when it's a new tax year. So you might want to, kind of analyze where your income is at this point, your cash flow, and decide, okay, you know what, I think I'd rather take some more income into 2023. There could be many other circumstances in the taxpayer's situation outside of even their self-employment activity that would result in them being in a lower tax bracket in 2024, at which point, they might want to have more income, or vice versa. They might want to have more income in 23 versus 24, depending on what their changing situation would be. So it sounds to me like there's probably going to be a change in a tax bracket or maybe a filing status where they're going to say, okay, looks like my tax rate's going to be lower, my tax bracket's going to be lower next year. Why don't I purchase that equipment this year, show more income in 24 and have that, it just really depends even where you fall into that tax bracket. So, but changing self-employment income has, other ramifications outside of that actual Schedule C or that self-employment form. It could affect things like self-employed health insurance deduction, self-employed retirement plan contributions. So you kind of have to really look at a lot of other things, look at that big picture. So retirement really could be its own session, that is for sure. Just talking about the Secure Act 2.0, this was passed at the end of 2022, made some major changes to employee and employer retirement plans. And these have become effective in 2023. So what's new with the Secure Act 2.0? So this is kind of a mouthful, so I'll sort of unpack it slowly here. So it increases the age for the required beginning date for mandatory distributions. Under the Act, the current required age component used to determine RBDs, or required beginning date, is referred to as the applicable age, and increases from age 72 to either age 73 starting January 1 of 2023. And this is for individuals who attained age 72 after December 31st of last year, and age 73 before January 1st of 20, and age 73 before 1/1 of 2033. So, and then there's also age 75 starting on January 1st of 2033 for individuals who attain age 74 after December 31st of 2032. So a lot there, a lot to wrap our heads around, but this applies to distributions to be made after December 31st of last year, with respect to individuals who attain age 72 after such dates. There's something new that I just recently learned about that are taking effect, a change that's taking effect in 2024. So that is the penalty-free withdrawal for certain emergency expenses. There's usually there could be a 10% penalty for taking early distributions from certain retirement plans. There is a new exception to this rule, the 10% early withdrawal tax, which is for emergency expenses, which are unforeseeable or immediate financial needs relating to personal or family emergency expenses. There's only one distribution allowed per year up to $1,000, and the taxpayer has the option to repay the distribution within 3 years. No further emergency distributions are permissible during the 3-year window, repayment window, unless repayment occurs. Okay, then we've got some considerations related to the net investment income tax. So converting a traditional IRA to a Roth IRA is going to increase your income for that particular year, and potentially could expose the income to the 3.8% net investment income tax. So strategy here, if possible, is to time the conversions to keep income below the net income, or the NIIT threshold. So if other net investment income will be lower next year, you could consider delaying that conversion. This timing, along with timing your first 2 RMDs, or required minimum distributions, that also increase income and subject the taxpayer to the net investment income tax, should be considered. So lots of moving parts there. So here are the 2023 and 2024 retirement contribution limits. We've got $22,500 for those 401k contributions for individuals, and up to $23,000 in 2024. We've got the catch-up contributions listed here, and then the traditional and Roth contributions and catch-ups, as well as the health savings account contributions for single individuals and for families. Okay, so now get into gift and estate tax briefly. Really what's new here, and for the time being, is just, how the annual gift tax exclusion continues to creep up a little bit each year. For 2023, the annual gift tax exclusion is $17,000, and it's going to rise up to $18,000 in 2024. The unified estate and gift tax exclusion amount, those amounts are listed here as well: $12,920,000, $13,610,000 for 23 and 24. These are going to could potentially have big impacts, big changes, if those Tax Cuts and Jobs Act or pre-Tax Cuts and Jobs Act levels are to return. So again, for 2023, up to $17,000 of gifts made by a donor to each donee is excluded from the amount of donor's taxable gifts. A gift that qualifies for the exclusion is not subject to gift tax or generation skipping transfer tax. The unused annual exclusions can't be carried over to following years. They're basically forever lost. It's best to make those exclusion eligible gifts as early as possible so as not to lose any of their benefit. A married couple, just for the way of kind of explaining how this could happen if in that situation, can gift another married couple up to $68,000 per year and still qualify for the exclusion. Tuition medical expenses. So tuition payments made directly to a university and medical expenses paid directly to a medical care provider are exempt from the gift and generation skipping transfer tax. So they don't count towards the annual gift exclusion amount or lifetime unified credit. And the donor does not need to file a gift tax return to report those particular types of gifts. So those tuition and medical expenses paid directly to the recipient institution. Okay, so some people might have heard of a technique called superfunding, a 529 plan. This is where you're giving basically $85,000, a gift that is made in 2023 to qualify for annual exclusions over 5 years. So you're funding it all up front and then, you know, using up your exclusion for 5 years in terms of contributing to the 529 plan. Okay, so I do see a question coming through related to gifts. And the question is, if I make a gift, does the recipient have to file a form or pay any tax? This is a very, very common question we get asked. Every time someone hears the term gift tax return, they immediately think, well, who pays tax? And they, you know, most people think it's the person receiving the gift that has to pay some sort of tax. The person making the gift typically does not pay tax on that gift, but will have to file a gift tax return when the gift exceeds this annual exclusion amount. This is going to be on a form 709. It is due on April 15th, just like the 1040 is due. So again, you know, here's the exclusion amounts. If a gift is made to one individual of more than 17,000, or 34,000 for gifts made by a couple to one person, this form has to be filed. Really, it does help to track individual gifts over one's lifetime, but there is no tax due by the person receiving the gift. Okay.
Lisa, I have
so
another
also,
question that came in. If you could go back to the last slide and just go over the, sorry, one more. The net investment income tax thresholds again. Could you restate those?
I don't have thresholds for the net investment income tax. The tax itself is 3.8% of the net investment income. Okay, and it just depends on what the person's net investment income is, as well as what their modified adjusted gross income is.
Okay.
I can make a note and forward those so you can put those with the presentation if you'd like.
Yeah, perfect. We'll put it in the comments of the recording for sure.
Great.
So
okay, perfect. Okay, so I was going to talk about the kiddie tax for a second. So the kiddie tax is still out there, and it can limit tax savings from intra-family gifts of income-producing property on investments or investments. So under the kiddie tax rules, a child pays income tax at the trust or estate marginal rates, which are quite a bit higher than their typical ordinary income rates. This is going to be on the child's unearned income over the kiddie tax exemption amount, which is only $2,500 for 2023 and $2,600 for 2024. And that's if that tax is higher than the tax the child would have otherwise paid on the income. So you really have to kind of watch where your child's unearned income is kind of falling through, so as to avoid, you know, that kiddie tax if possible. So alternatively, the parent can elect in some cases to include the child's income on their tax return. One strategy here is that children 18 and older can increase their earned income to exceed more than half of the cost of their own support, not file as a dependent, and then avoid that kiddie tax on their unearned income. This does not apply for children under 18, just 18 and over. Also note, in all cases, the child's unearned income can be sheltered by the child's standard deduction and other deductions. So earned income exceeding those deductions will start to be taxed at the child's tax rate. Okay, so that is all I have. I have just a couple of, just a little hodgepodge, a couple of final reminders. Just generally speaking, when choosing a tax preparer, there's a couple of important things to consider. As that time does start to roll around towards December, January, of course, when the calendar flips and it's tax time, you'll want to choose your tax preparer very wisely. You are responsible for all of the information on your tax return. Ask the preparer about fees and if they plan to use electronic filing, making sure that that person is going to be accessible to you for questions and available, long after your return is filed for any other issues that might arise. Check the person's credentials. Only attorneys, CPAs, and IRS enrolled agents can represent you before the IRS in tax matters. Avoid tax preparers who claim they can obtain larger refunds than other tax preparers, something to be wary of. Avoid preparers who base their fee on a percentage of the amount of the refund. And, certainly just ask for referrals from friends and family members or from your attorney or financial advisor on reputable accounts that they would recommend. Stay informed and stay organized with your documents. It has many benefits. This goes out to individual taxpayers and even business owners of large, small, and even very small businesses, even our sole proprietors. Keep your personal and business finances separate. Work with a professional, a tax accountant, CPA, especially one that is familiar with your circumstances or your craft, your specific industry, if you're a business owner. Keep good records. We can't say that enough. Keep all receipts and records of purchases related to your situation, receipts related to large purchases of equipment or what have you. Just stay organized. Implement a few practices into your daily, weekly, or monthly routine, and you'll be ready to go, real organized when tax time arises. But I hope this has been helpful and informative to you. And please don't hesitate to reach out with any other questions. Use the tax text line to get some clarifications, or if you have any follow-up questions on anything I discussed.
All right. Well, thank you very much, Lisa, for a great presentation tonight. If anybody has any questions, you can always reach out to us at the firm. I want to repeat that text line one more time. If you text the word tax to 716-727-5047, we will make sure we follow up with you personally. And otherwise, everybody have a great evening, and thanks for attending.